let's see if we can shine some light on what's happening right now. Probably no more amazing topic to talk about. I want to spend a second on the disclosures here. The one that we don't have written down, though, is I don't want you to take anything that I say as specific investment advice. You cannot accrue that I'm speaking to you individually. I don't know your needs, your objectives, your risk tolerance, time horizon, that kind of stuff. So if you hear something that you really, really like, we want you to go to your financial professional and hopefully they're at CalCoast and take care of things there. We're working with somebody who knows you. That said, it is important, at least annually, to meet with your financial advisor. And if you don't have one, CalCoast has some terrific advisors, and we'd encourage you to utilize them. Revisit your goals and objectives, particularly in periods of heightened volatility like we're in right now, in a 24-hour news cycle and bombasting you with fear and what have you. It really makes sense to revisit your goals and objectives really on a quarterly basis. Understand the rationale for your investment strategy, the rationale for your financial plan and related choices. You ought to be able to relatively quickly explain what your investment strategy is. And if you can't, then you need to sit with your advisor and go over it a couple more times and make sure it's consistent with your needs and objectives. We want you to set realistic performance expectations. We'll spend a little bit of time on that for you today. And then discuss how to prepare yourself financially and mentally during times of market decline, and we'll spend a couple of minutes on how to protect your assets and income. Mentally in the market decline is so important, and we have to learn from history. And historical market performance is not indicative of a guaranteed future results, but we refer to the experiences to establish context and perspective. Every generation faces its own share of challenges. I have another slide that we don't use in here because it gets too crowded, and it literally takes the last 95 years and lists all the reasons you shouldn't have invested. What we have here, the light blue line is the Standard & Poor's 500 going back to 1900. The darker blue is volatility in the markets. And then we tried to highlight some of the incredible things that have happened that would give you all of that heightened volatility, would give you pause to invest, and yet the markets have, over any significant measurable time frame, moved ahead. You know, I do a workshop called Investing in Turbulent Times, and it's kind of a trick because the times are always turbulent and there's always reasons not to invest and there's always reasons to panic. So let's chat about a couple of things that are going on today. I want to spend a second on midterm. Let's just say they've got a reputation regarding market and market performance. This is the presidential election cycle. It takes the years of the presidency, starting in October of year one, year two, year three, year four, and shows the average returns of the Dow Jones by quarter. And this goes back to 1896, even before my time. I've been doing this 40 years, and even before my time. So as you can see, in the first year, it's kind of a mixed bag as to what happens. The second year, the one we are in right now that we just finished up, as a matter of fact, is the worst year for investment performance. And there's rationale for that, and I'll get into it in a second. The third year, which we're just starting the quarter that begins October 1st, and we're in it right now. And as you can see, it's the third year is by far and away the best year. And I'll put some numbers on this in a second for the stock market. And then the fourth year is a very complicated year because of the presidential election. And it's also the year when we're most likely to have a recession, the fourth year, which would be 2024. And a little factoid here, since history is my deal, we've never had a recession start in the third year of a presidential cycle. So there's a lot of calls right now for recession by the end of this year or next year. And we think there's a high probability that that recession could be pushed off even further down the road. And we'll get into why here in a second. So this is that slide is a slide that talks, it's not meant to show you specifics, but to help you with the direction of the markets historically. Also, In midterm election years, this goes back to 1970, volatility spikes in the months leading up to the midterm election, where we are right now and where we've been for the last few months. And you can see here, midtown election years as measured by standard deviation on a daily return, and for each and then put together for each individual month. For midterm election years, it's the darker blue, and for all the years, it's the I don't know what color that is, but anyway, it's you can see though that volatility spikes dramatically in the years that we're in the months of right now. So there's rationale and reasons for this. The previous slide, the rationale for the third year being such a good year is that in the first year of a presidency, that's when the president generally gets their way a little bit and they get to pass some usually money spending initiatives. In the case of the Biden administration, it was the infrastructure bill, if you remember that. But what we know is that that money takes a while to get through everything on the federal side, and it generally doesn't hit until the third year of the presidential cycle. So you're going to hear a lot of talk, I'm sure in San Diego, we're already hearing it in Phoenix, of infrastructure spending with federal funds. And that's all going to be hitting in year 3, which is one of the reasons, one of several, that the third year is a special year for investing returns. We can go forward. So this is a very busy slide, and I'll try to work it with you here, but markets have historically been volatile in year 2, which we just talked about, of a presidential cycle, and perform strongest in year 3, regardless of the outcome of the midterm elections. And that's an important statement. Regardless of the outcome of the midterm elections, the markets generally do very, very well. And you can see in the middle there that the average for going all the way back to 1900 again, and the average year 1 about 11.5%, year 2, this is the Dow Jones average 7.2, year 3 16.6, and year 4 12. And so despite you'll hear a lot of talk of the markets preferring divided government, the market results, whether it's divided government, divided Congress, are all very close to each other. And I've got some of those numbers down a little further into the presentation, and you can see graphically right here how they perform 12 months before and after the midterm election date. And it kind of doesn't matter what happens, as you see with the election. We drop into it in a negative manner with all of them, whether it's single party Republican, single party Democrat, divided government, or the Senate and House changes. And then really the third year is the year right after the election is a surprisingly good year, no matter what is happening. So we do like where we're headed. Since 1962, this is even more specific here. This is a pretty amazing. It's actually not, we've gone back and done a little bit of research on this, and we think it's actually 1958, but we'll use 1962, the Kennedy's midterm election. The S&P, we were talking about the Dow in the previous Dow Jones average. This is the S&P, has never lost ground in the October to October period around the midterm election. So we just saw that the Dow has a 91% win rate during midterm election, the year following the midterm election. It's 100% S&P since 1962. In other words, there's not been an October to October year, which we're just starting right now, that this October to next October in the midterm cycle has never had a losing year for the S&P 500. And in fact, historically has performed very, very well, up about 14.3%, which is the post-election high. And you can also see on this graph that midterm election years, the Dow average is only 1% in January to October pre-election. So it's been a lot worse than that, but that's an average. So again, the S&P 500 has never lost ground, and the Dow has about a 91% or 9 out of 10 chances of gaining in the forthcoming year, October to October. Hope that makes sense. And then I said a minute ago that, and I do a workshop where I say politics is not an investment strategy. And while we get very worried about things, here's the actual numbers of the S&P 500 going back to 1933. A unified government, 10.4% average annual return for the third year, 7.4% with a unified Congress, and a split Congress at 10.8%. All those numbers are very good numbers, and we'd take them right now given what we've been through. So that's where again, politics is not an investment strategy. So we've tried to put a little historical context and perspective around where we are in the bigger picture of markets. And, the thing about history is it does repeat itself, but sometimes it doesn't. We'll see. This has been a strange 3 years we've been in. We started with the pandemic. I hate the word unprecedented. It's thrown around so much all the time. And most of the time when somebody says unprecedented, it probably is precedented. They just don't know it. But in the case of the pandemic, that was unprecedented. What we did in the United States had never been done. We went to people and said, you have to shut down your business, go home, send your employees home. You're not going to make anything. You're not going to bake anything. You're not going to do anything like that at all. Go home and we'll call you when you can come back. It was staggering for business owners. The only plug you're going to hear me make today is that there's a Philly cheesesteak place right down called Taste of Philly. And it's owned by John and his wife. And I've known them for 30 some odd years. They immigrated from Albania. Albania is the only country that, North Korea looks up to, but it's the only country, Albania only looks up to North Korea. But they've come here, classic American success story. They saved up their money. They bought this little restaurant. They've put their kids through college. They live in a nice house up in Scottsdale. They've done everything right. And John's ready to retire. And he's got a sale he's ready to sell it. He's got a buyer. They're all ready to go. Bam, the pandemic hits. So not only is he sent home, but the buyer leaves, obviously, because he's not going to buy something that he doesn't know whether it's going to open or not. And of course, John isn't going to buy his buns, and he's not going to buy his meats or his vegetables or any of that. So his supplier isn't going to order anymore. And that supplier isn't going to order anymore, all the way back to the grocers and manufacturers. And that's what the disrupted supply chain was. And amazingly, because of the vaccination that was developed, whether you took it or not, I'm not going to argue that, but the vaccination allowed us to reopen quicker than I think anybody thought we would. But the damage was done. We had literally shut down the largest economy in the world. But we did it quicker and faster and recovered faster than anybody else. China is still struggling with the pandemic, and Russia is too. We just don't know because they don't produce the numbers that we'd like. So we get that done, and then we just start to feel a little better about, Christmas last year, we weren't able to buy a lot of the things we wanted because they were stuck in ships all around the world. And now we've got double inventories. And so we're going to see stuff on sale. And we just started feeling a little bit better when Putin invades Ukraine. And while that didn't have a lot of direct economic impact on us, it did force oil up. And of course, that was this summer. And I don't know if you noticed it. We certainly did here, and we certainly did with our clients. And we talk to our clients a lot. They're our best source of intelligence, of intel. But a lot of people traveled this summer by car and didn't care about the cost of gasoline. It bothered them, but it didn't care. And I'll talk to you why in a second, because it's making things even more complicated down the road. So we just come out of the pandemic, then Ukraine, and then because of a combination of those forces, we see inflation raise their heads. And if you're as old as I am, some of you probably are, then we remember the 1970s. And the question is this a return to the 70s, which was a decade of really horrible economic results? We'll talk about that in a minute too. So now we've got a Federal Reserve that's trying to slow down the economy to get inflation under control, and they're having a tough time, and there's a reason for that. And so recession, if so, what kind and how long? And so when somebody says a recession's coming, the question to them is, what kind of recession? Is it just a technical recession? Is it a profits recession? Is it a rolling recession? Is it really a cyclical downturn versus a broad recession? What we're worried about, and what our clients are worried about, is what I call a capital R recession. A recession where all the help wanted signs that we see all over the city get turned into going out of business signs. And instead of help wanted, we start seeing hundreds and hundreds of thousands of people on a weekly basis applying for new unemployment insurance. That's a capital R recession, and that's what we've got to avoid completely. So let's go forward here and take a look at recessions. This is a very complicated little chart here. Christine, do we have some questions?
We do, and they are regarding recession. So I'm wondering if you want to address now, or should we wait till after you?
Well, let's get through this section and then we'll take a look at it. Maybe we'll answer the questions and maybe we won't. We'll give it a shot. Okay. So what happens to the stock market during recession? Historically, the stock market will peak 6 or so, 7, 8 months prior to the actual business cycle peaking. So the market tends to move ahead. And then you have continued downturn for another 6 months or so. And then you have both the stock market and the business market, if you will, the economy headed higher. And the stock market heads higher. So where we are exactly, you could say we're just past, a little ways past where it says cycle peak. A lot of people believe that the economy peaked last year. So we're 6, 8 months. We're very close to where we could start to see the stock market start to head higher, and then a few months away, potentially from the industry, from the economy heading higher. So it's going to be interesting to watch for this going forward. But that's what we're looking at right now. You hear a lot of talk about an inverted yield curve, and the inverted yield curve is the most accurate and widely cited recession signal. The yield curve inverts when short-term interest rates are higher than long-term rates. And this market signal has preceded every US recession in the last 50 years. Short-term rates go up because the Fed is tightening, long-term rates fall because there's less demand for goods and money. And interest rates are nothing more than the price of money. It's a simple way to think of it. Always think of it that way. Interest rates are the price of money. And in a recession where you're slowing down economic activity, that means fewer people are demanding money in the way of longer term loans, and those interest rates will come down. And so it does tend to predict recessions. What kind of recession? Well, some small recessions, some very light recessions, and a couple of big ones. But there's no commonality there. And on average, it's a very leading indicator. It's a year or more before, from the time we start getting inverted yield curve to on average when the recession hits. So we could be in one right now, or it could have been just predicting the one that we had in the first half of this year, if indeed that turns out to be dictated as a recession by the consumer board that handles that. So it's not a cause for immediate panic because of the lag time we have until the recession. And let's go to the next slide. I think will help. So what economic indicators can warn of a recession? Well, the number one is the inverted yield curve. And as you can see, it's the 10-year yield is below the 2-year yield, and it's often the sign of the Fed is hike short-term rates. Average month until recession is about 14.5. And the yield curve started inverting in early July. So it could go out until next year or even the year after before we have a big recession or even a recession that we notice. We spend a lot more time looking at a couple other things here. We spend a lot of time looking at unemployment. There's 3 different ways we look at unemployment, because it's pretty much impossible to have a recession with a capital R, a big recession, when everybody's working. We have to start seeing erosion in the labor market, and we haven't seen that yet. And the Fed is looking for that, and it's one of the problems that the reason they're still hammering away at interest rates is because they haven't seen unemployment breakdown. We also look at the leading economic index, and it's an aggregator of about 10 different indexes or different measures, and it's a very near-term indicator. And the leading economic indicators has been growing, but at a decelerated rate in recent months. So we'll have to see what happens there. So there's a lot of factors, and you have to be aware of imbalances in the markets. But right now, we don't see a recession, a noticeable, significant recession, which will cause economic pain, we don't see that happening in the foreseeable future. And a lot of people were calling for that this year. Doesn't look like that's going to happen. Some are calling for it next year, at the earliest, maybe towards the back half of next year. Here's what I spend a lot of time looking at. This is our weekly high-frequency data tracker. We get this put together, I think it's on Friday every week. I tend to look at it on Monday. And as I said, we spend a lot of time on jobs. The first three indicators are the initial jobless claims, that's the most important one, continuing jobless claims, and the American Staffing Association Staffing Index. And what we do is we compare it to the 2019, the same week in 2019, so pre-pandemic, and then we show its change month over month and week over week. And with the exception of box office receipts, there really isn't anything in here that shows a sign of recession, whether it's rail car traffic, steel production, TSA checkpoint data, hotel occupancy, weekly retail sales. We just don't see it. But the one number, and we get this number tomorrow, I'm pretty sure that we get the initial claims number tomorrow morning at 7:30. Is that right? Tomorrow morning at 7:30 Eastern time. I expect it's going to be higher than the 2019 level. I expect it could be in the 2.25 range, 230 range, 230,000. But we're not even going to get excited about that until it starts hitting 300,000 or more. And where we really get excited about it is when we start seeing 400,000 to 500,000 people put in their initial jobless claims. So again, we're a ways away from it. Doesn't mean it can't happen right or quickly, but it's a ways away. All the other indicators are showing very strong indications that the economy is going very, very well. So that's what we use, and that's weekly. Labor demand. I spend a lot of time talking to our clients. We have a lot of clients that either retired out of terrific jobs or are still working in terrific jobs, and I talk to them about what's going on in their business. Can they hire people? Can't they hire people? What about their customers? What are they hearing? And I met with one of our clients Saturday night, and he's a former senior director for one of the largest mining corporations in the world. He's fascinating to talk to. You can talk about how they mine in Africa or in Indonesia. But about a year ago, he took a job running a gold company out of Alaska that has mines in Alaska, Chile, and the Philippines. But he also has 4 other companies that report to him, building companies, et cetera, et cetera. And his one comment to me is, I'm still hiring and I cannot hire anybody. There just isn't anybody. And we're paying money like I've never seen before. We just had a significant drop off during the pandemic of people working. 2 types dropped away, and that's the JOLTS number in the upper right-hand corner, just people quitting. And one of them was they just retired. Maybe they were going to retire in 2 years, or maybe they were going to retire in 3 years, but the pandemic hit them. They came in, talked to us, and we said, can I retire now? We ran the numbers and said, yeah, you can retire now, and they did. And I'm talking senior managers, senior people, doctors, nurses, as I said, managers, sales managers, just tons of people just said, done. If I can afford it, I'm done. And then on the other end of the spectrum, the entry-level workers, we're seeing a phenomenon that's just being studied right now, but I think it's going to turn out to be true. And that is a lot of people, rather than work a entry-level job where they are where they have rules around them, such as having to show up to work at such a time and work for a certain number of hours and this and that and the other. They're not doing that anymore. They're doing the gig environment, kind of the gig economy. So let's say they stay home for 3 days, play video games, in some states smoke a little dope, whatever they're doing. And then when they need a little money, they go and drive for Uber Eats for 2 or 3 days, get the money they want for their lifestyle. Remember, this is entry-level positions, and they've dropped out of the employed category, if you will, and then they're impossible to get to report. So they're not even reporting into these indicators here. So we saw big quits in the upper right-hand corner, and we've seen almost no layoffs in the lower right-hand corner. You know, I hear today Intel announced some layoffs, and the companies that are announcing layoffs are the weakest links. So we're going to see if that's just very company specific or if it spreads to other companies. But we spend a lot of time looking at employment around here as a need for recession. So how close are we to the next recession? This is the New York Federal Reserve model of probability of recession in the next 12 months, and we're not there yet. As you can see, they really want a 30% threshold of what they call their recession measure, and it's a combination of things, frankly. I mean, I've got them written down here because I don't always remember them. Excuse me. Anyway, I won't bore you with it, but this is the New York Fed modeling recessions, and we're close, but we haven't broached that 30% threshold yet. A lot of people think we will in the next quarter, and if so, this is a pretty good indicator that we'll have a recession within the next 12 months. Again, it could be 12 months from now. That's putting it in late 2023, and again, we're kind of looking at that would be the earliest and more likely that we have a recession in 2024 when it historically hits. Remember, there's never been a recession that has started in the third year of a presidential cycle. You got to remember that a little bit. So how long do recessions last? Well, the average recession lasts about 10 months. It knocks down GDP by about 2.5%, and it takes out about 4 million jobs. But as you can see by this chart, our recessions have been getting shorter but deeper. The last two, the 2008 and the 2020 recessions, were short but deep, while the recoveries have been terrific. On average, a 69 months of expansion, GDP growth of 24, almost 25%, and 12 million new jobs added. So they just don't last very long, and this is going back to 1950. And they tend to be pretty small relative to the overall economy. And again, we don't know when somebody's on TV saying recession, nobody ever follows up and says, are you talking capital R recession or just any kind of recession? Because we can have recessions that we don't even know we're in, technical recessions, and that happens. But that's why I look at employment. So I'm going to go back to one of my little phrases here that Christine mentioned at the beginning of the broadcast here, and that is that successful investing is a constant practice of replacing fear and greed with perspective, context, and patience. And hopefully that's what we're doing today. So Christine, we had some recession questions. Is this the time to answer those?
Michael, this is a good time. All right, let me go to the first question. It reads, on the news, there are some forecasts that the markets will lose another 20 to 25% in 2023. Is there any bottom line we can start worrying? I wonder if that was meant to say, is there a bottom line when we should start to worry?
Well, a decline, we're already down about 20 some odd percent, depending upon what market measure you're using this year. So for it to go down another 20% or so, you're starting to get down 30 to 40% from market highs back in January and December. And those don't come around very often. We had one in 2020 because of the pandemic, and we had one in 2008 because of the housing marketplace. They don't come around very often. So it's, in my opinion, it's less likely than you would expect. But let me answer the question a little differently. It's always, I used to be on TV, I used to do all that kind of stuff and yap away, talking heads, et cetera, et cetera. And let me tell you one thing you learn pretty quickly, or if you're not told to do it this way, is that negative news is always easier for it not to happen. In other words, America's generally a positive country. And so if I come out and I say, gosh, throw all your money in the market, it's the greatest thing in the world, people might actually do that. And then if the market doesn't go up, I'm in big trouble. But if I say, look, if the market's going to go down 20%, you better do something. Most people won't react to that. So if the market doesn't go down, nobody cares that the person made that comment. So it's easier to be negative when you're a talking head on the news. It's less reputational damage if it doesn't come through. And also, they want you to come back and watch the news. So they're not going to tell you anything that's good. They're not going to say, look, our indicators tell us we're great for the next 6 months. Don't come back and watch the news. Not going to happen. So I would just put that in the context of all the information we're giving you today. And then at the end, we're going to talk about things you can do with your portfolio, and we'll spend a little time on that, okay? Another question?
Okay, second question. If a recession is coming, is there any suggestions for keeping some cash instead of investing all cash available?
Yeah, we're going to talk about that in just a minute, but let me answer this real quick. There is a theory now with this new economic environment we're in, where maybe interest rates might come down a little bit, but over time they're likely to rise over meaningful periods of time. We're not in the low interest and falling interest rate pattern we've been in since the early 80s. If indeed we're in a slightly rising interest rate environment over time, some advisors are questioning owning bonds in the portfolio. And what they would rather do is say, go put not 6 months of money in the bank, but go put 2, or in the credit union, let's go put 2 or 3 years worth of your living expenses and not own any bonds, so that you can weather things like what we've been in right now, because you got all the money in the bank and yet you're still invested. That's one way of doing it. I'll talk about some other suggestions here in just a minute. Good question.
Great, thanks, Michael. Okay, and John asks, Mike, despite historic trends with regards to elections, aren't things different this time due to severe climate-related disasters such as drought, flood, hurricane, wildfire, crop failures, not to mention the devastating war in Europe?
Well, it's a good question, and I'm certainly no expert on climate change, but it seems to me in the world, climate change, there's going to be areas where the climate changes to the negative and areas where the climate changes to the best. Maybe super cold areas don't become as cold anymore and they become more fertile, this and that and the other. I'm a child of the 70s. I went to college in the 70s, and the big thing then was the population bomb. And books were written about the population bomb and how the world wasn't going to be able to survive another 10 or 15 years because we're just going to have too many people and there was never going to be enough food, et cetera, et cetera. And that didn't come to fruition for a lot of reasons. There's more food, more people, fewer people are in starvation than ever before in the planet, et cetera, et cetera. The other thing that I lived through was the great oil explosion. There were books written that said that the United States and the world would be out of oil by 1990, and that we would never, it was going to cause great calamity, and the United States was going to fall as a world power, et cetera, et cetera. And that didn't happen either, primarily because of technology. So you're going to see another slide here where I talk about my personal philosophy when it comes to these catastrophic projections, and maybe that'll help put it in perspective. I'll try and get to that at the end here.
Okay, Michael, one more question and then we can wrap these for now. How can we rely on historicals when this has been such an unprecedented time? I feel like historicals go out the window in this market, don't you?
No, I don't. Number one, because what's the alternative? If you're not going to have, and we don't have to rely on them exactly, but they can help nuance and balance how we look at things a little bit, because you're not getting balance from the news media. That's not a liberal conservative thing, that's just media in general. And if it bleeds, it leads, and that's still how the media is today. They want you to come back and watch them tomorrow. So they're not going to make you feel comfortable. They're going to make you feel uncomfortable. And you have to put that in perspective, literally with every piece of news that you take in. So, but short of historical perspectives, what perspectives should we apply? There isn't another one. And until it comes off the rails, I guess I'll stick with it. It could come off the rails, could not. I mean, I guess I could assume that Putin's going to ignite a nuclear war. I don't know what I would do about that right now. So I think I've lived through so many doomsday scenarios, and we've gotten through them. Sometimes not very cleanly, but we've gotten through them, and we haven't had any doomsday scenarios put us out of business yet. So let's move forward then, because I want to wrap this up in about 5 minutes and we're getting to the juicy stuff. We've got a little slide on asset and income protection. What do we do? You should, if you're worried catastrophically and about the future, life insurance, there's 2 reasons to own life insurance: to protect an estate if you have quite a bit of assets and you want to make sure that there's money to pay taxes on those, even if you've done good planning with wills and trusts, or to create an estate. Maybe you haven't had the ability for, it could be on a personal judgment, to create an estate and you want to have a bucket of money at the end. Those are the 2 reasons to own insurance. And then annuities protect income. I know annuities get a bad reputation, but that's because bad people sell bad annuities. If you're working with somebody like our advisors, frankly, at the credit union, we have all kinds of rules in what kind of annuities they can sell and not sell and offer to you. So options are broad and customizable to your needs. You've got fixed, indexed, hybrid, variable annuities. You have all kinds of guaranteed options for income, long-term care, and more. And depending upon the contract, variety of investment options and volatility buffers. Just a personal note there, my mom lived to 102, passed away 2 years ago. And if we had not had annuities paying her lifetime income, as well as long-term care income, the financial burden on me would have been enormous. And not that I wouldn't have done it, of course I would have, but it would have been a challenge. And so there's reasons to have people have lifetime guaranteed incomes. If you don't have a pension, that would be to look at it. Next slide, please. How should you position your, oh, I'm sorry, no one has a crystal ball. Oops, I skipped ahead, sorry. No one has a crystal ball. That kind of goes to some of the questions that were just asked. And we have to, this is the old, if you miss the days, the best days, it knocks your return way, way down. You know, I'm not a big fan of that on the left-hand side, because if I put underneath that, if you miss the 10 worst days as well, you know, somebody who gets out of the market kind of balances this out. But here, if you're in the market on the right-hand side, you'll see many of the best days occur during periods of volatility. So we will, we encourage people to stay in the market. Real quick, here's a drill for you. I just sent this letter out to all of our clients a week ago. If you don't know whether you should move to cash or not, cash is tough, because if you move to cash, it just sets up another more difficult decision, and that is when to get back in the market, because there's always reasons not to invest, and I'll show you that in 1 second. But if you have some stocks, and if you don't know what your stocks are, get to your mutual funds and your ETFs and look at the top 10 holdings. And if you recognize those names, and in the case right now, you've got some names, big cap techs that are down 20, 25, 30%. This is not specific investment advice. I don't know you. I don't know your needs and objectives, et cetera. But some of these stocks are way, way down. Well, if you bought some 3, 4, 5 years ago at a much higher price, and today they're at a lower price, and you really think they're a screaming deal, what, are you going to get out of them over here just to buy them again? No. So if you would buy them with today's money, if they look like a deal today, then you should continue to own them with yesterday's money, because the company doesn't know what you paid for them. If you think it's got a great future going forward, whether you spent $70 or $100 per share, you need to, if you think it's a great company and it's going to do well, then you need to own it regardless of price. So that's a way to think about things about going to cash. Let's go to the next slide. We've got to run through these. Stock portfolios. This is a very busy slide, but it basically says that if we go into a capital R recession, you're best to be in consumer staples, utilities, healthcare, things like that, things that we're not going to give up on. Amazingly enough, though, big tech might be considered a consumer staple. There's been a lot of surveys done where people are willing to give up all kinds of stuff, but they want to keep their streaming service, and they want to keep their Amazon account, and they want to keep their phone account. So it may be that large cap tech, like it was in 2020, turns out to be more of a consumer staple. We'll see. But this is, and you kind of want to avoid the things that have long lead times or are very interest rate sensitive, like industrials and financials. Okay. Next. Oh, I'm going to only spend a second on bonds. One of the reasons this has been such a difficult year is it's been the 3rd or 4th worst year in the stock market. But normally, if you have some bonds, like in a 60-40 portfolio, those bonds serve as a buffer, and they either stay the same or they go up in value. But this year, bonds have had their worst year ever. In fact, I'm going to show you the slide in a minute. So what happens is instead of helping the portfolios like it did back at the flash crash and U.S. debt downgrade, it's hurt the portfolio the last three big downturns we've had. And that's because interest rates are going higher, not lower. And so, you know, the idea of holding bonds, it may be better to go get CDs at the credit union or annuities at the credit union that are fixed and you know, keep 2 or 3 years worth of liquidity, and then you ride out the storm. Next slide, please. This one is one of my favorite slides. I just got to put it up here. It's a myth that the U.S. is a bad credit risk. Don't you wonder if we've got 28 trillion, 29, 30 trillion, it's really closer to 30 trillion now, in debt, why do companies and why do countries still keep buying the United States debt? Why is the United States dollar the currency of choice when things get bad? Well, it's because if you did a balance sheet and not an income statement, if you did a balance sheet where you listed the assets of the United States versus their liabilities, looks pretty good. The assets are greater than 200 trillion. And the liabilities are 30 trillion. And this kind of outlines that for you. You know, I have all kinds of stuff I could say about this slide, but it's just a different way to look at things. Yes, we don't want to have debt. I get that. But as a percentage of our net worth, our debt and our debt service are pretty low. This is a great slide. This is the S&P 500. Every year shows you the inter-year drop, and it averages 14%, and then where the returns, where it wound up, and it's positive in 32 of the last 42 years. So we've had years like last year where the market was down 30, well, I guess it was 2020, when the market was down 34% and wound up 16. This year we're down 25 and we're still, there was the low point, we're still down 20. Go all the way back to 2008, at one point down 49%, but and finish the year down 38. But there's several here where, like 2010, where you were down 16 and you wound up 13, or 2009 where you were down 28 and it's not where you go during the year, but it's kind of how to measure it at the end of the year. The point is lots of double digits in red here, which tells you the volatility of being a stock investor. You've got to get used to those double-digit losses, or else maybe you're just not a stock investor. Next slide, please. This just shows the bond market, far right-hand corner. The bond market down 14, 15%. We've never seen anything like this. You hardly see any negative numbers on here at all. And that's what's killed your portfolio. It's not that the stocks, we've gone down 20, 25% in the past, but we haven't had bonds contribute to the overall net losses. Bonds have had a real rough time this year. But markets bounce back, and this is the S&P price index, and 1, 2, and 3 years after a market correction. For somebody could tell me, as the really good question was, but isn't it different this time? But we had those same questions in 2008, 2009. Isn't it different this time? We've never seen a housing market where people were going, literally losing their homes, et cetera, et cetera. It was always different, right? And in 2000 and 2001 and 2, and when the tech bubble blew up, we've never had anything like that. So can we rely on history? Well, we did, and we have. So I maybe this helps you a little bit. In 2000 and 2001 were the years where it didn't come through, but otherwise, with the exception of 2008, for every kind of, and even if you have to wait out 3 years, the only real terrible time was 99 and 2000. So out of this whole deal. So I guess I rely on all those other years rather than the 2 years where it didn't work out. Real quick, helpful guidelines. There are always reasons not to invest. You've got to do it anyway. Your investment time horizon is very important as to how aggressive you'll be. Know the reason you bought each investment. If you buy, let's just say Amazon, because you love the fact they're going to have 1 hour delivery, if that doesn't hold true, then you need to sell the stock. If the reason you bought it continues to be valid, keep holding the stock. If the reason isn't valid, get rid of it. Interest rates are the price of money, and the law of supply and demand applies to money. Our economy can grow with inflation at 4 or 5%. It has in the past, and it will. It's when it gets up 6, 7, like it is right now, that it starts to stall out. But really, all inflation interest rates is the cost of money. And if your economy's growing and there's a lot of demand for money, then interest rates will go higher, and yet you can have a very strong economy. Know why you own your mutual fund or ETFs. You should know whether it's process-driven or a superstar manager. If it is a superstar manager, when they leave, you leave. I got a whole Michael Jordan analogy that I don't have time for. Don't fight the tape. Don't fight the Fed. There's a third one in here. Don't fight the U.S. consumer. And that's the problem. You've got the consumer with a lot of excess capital that's still spending like crazy while the Fed is trying to tamp them down. And it's harder and harder. And that's why people are worried that the Fed's going to have to hit harder and harder. And at some point, break the consumer and break employment. And it'll do so in such a way that you'll have a capital R recession. I don't think that's going to happen for a lot of reasons, and hopefully some of the ones you've seen today. Don't confuse brains with the bull market. I've been in this game long enough to know that one. Believe your beliefs and doubt your doubts, and working with an unbiased financial advisor is a good investment. What else do we have here? This goes to one of the questions we got earlier. For every problem or crisis, there's an infinite number of forgotten or undiscovered solutions. We've got to be open to all kinds of solutions. There are, regarding climate change, there's all kinds of forestation going on. There's decarbonization going on. They've got a type of feed for cattle that stops the cattle from belching, et cetera, et cetera. There's all kinds of technology out there. We've just got to be open to using it and taking care of things. We are still amid a long-term secular bull market. Its transformative and disruptive technologies continue to sweep the economy, similar to what we saw during the Industrial Revolution. The Industrial Revolution is a terrific model of what we're doing today. Really terrific model. Automation, e-commerce, genomics, fintech, cybersecurity, et cetera, et cetera, et cetera. Remember, coming out of the Industrial Revolution, we had 5 or 6 super companies that stayed as super companies until they got broken up. So Standard Oil, AT&T, et cetera, et cetera. We're very similar today. Just the thought process as we wonder, does history help us? What else do we have here? Questions and next steps. Christine, let me do the next steps and then we'll take the questions. What were the next steps? Call your financial advisor. If you don't have one, CalCoast can help. Great advisors. Analyze non-qualified accounts for tax harvesting if appropriate. Now's the time to clean up the portfolio and get a little tax help. Upgrade the quality of your investments in all your accounts. If you're really worried about a recession, upgrade everything. Upgrade the bonds, upgrade to the biggest stocks, upgrade, and discuss your current investment allocation strategies as it relates to your goals and risk tolerance. Okay, Christine, I was a little longer than I thought. I apologize for that.
No, that's great, Michael. It was a great presentation. We do have a couple of questions. I'm going to read this one from Joni verbatim here. I have a person who is recommending life insurance and annuities as you never lose money, says once the stock market goes down and the stock prices goes, I assume, down, you lose, say, 50%. Then when it goes back up, you never recover all that you've lost. Please elaborate on losses and how you can break even or get a profit after the stock market goes down.
Okay, so when the stock market goes down, you do what we just talked about. You reevaluate the quality of your investments and whether you are comfortable with those names, those companies. Do you think they're going to do well going forward? You know, let me take Amazon. 15 years ago, Amazon wasn't making a profit. It had years where it lost gazillions of dollars. Stock was all over the place. The question was always about, is Amazon really going to be a real company or not? If somebody bought $1,000 and just let it ride, they're doing very, very well today. Same thing of Apple. And remember when Steve Jobs died, everybody said Apple's dead. It's never going to happen again. So you have to you have to look at what you own first and foremost. If it's quality stocks, quality companies with quality products and services, and ask your friends. If you don't know whether it's any good or not, ask your friends that are using it or know about it and see what they say. And then you can hold it and it will perform better for you over the long haul. There's a slide, I don't have it today, but it says, I think if you hold for 5 years, I think you have like a 92 or 93% probability of making money, and you go out to 7 or 8 years and you have 100% probability if all you own is like an S&P index, but I didn't bring that slide, so I'm sorry. Regarding the insurance and annuities, I would always get a second opinion. And first thing is, the person you're dealing with, are they only licensed to sell insurance and annuities? If that's the case, they've only got one solution for you. You know, you want a financial advisor that can do everything, that can manage money, do brokerage, do insurance, do annuities, and so that they have the whole range of solutions available to you, so they're not trying to pound you into a solution that might not be the best solution. Next.
Great advice. All right. John asks, regarding bonds, why have they been so down this year? And because they are down, is now a good time to invest in them?
So it's a great question. So you have to ask yourself, what do you think is the long-term path of interest rates? And the reason they were down so much is people panicked at the Federal Reserve. They thought that the Federal Reserve, as they have, could be raising rates 13, 14 times. So the bonds went down as if the Federal Reserve was going to be raising interest rates for 2, 3, or 4 years. And when interest rates go up, the value of the bond goes down because the cash flow, the payment from that bond is worth less. If I loan you $1,000 and it's at 8%, you're going to pay me $80 every year. Regardless of what happens to the value of my bond, I'm getting my $80. But if interest rates go up to 10%, I loan somebody else $1,000, they're going to pay me $100. So that income stream is 100 as opposed to 80. So a $100 income stream makes the $80 income stream worth less. So as interest rates go up, those lower interest rate bonds go down in value. So if you think interest rate inflation are going to continue to march higher for many, many years, you probably don't want to be in bonds. However, a lot of people right now think they're a great place because they think interest rates have nearly peaked.